Welcome to the Deep Dive, powered by Talk Tickers. We're here to cut through the earnings call chatter and get straight to the point. Today, it's all about GLP's Q3 2025 performance. And honestly, what management laid out this quarter felt like more than just strong numbers. It seemed like a real statement on, financial strength and how they're setting themselves up for the future.
Yeah, that's exactly it. That's the core story. So Our mission today is simple. Give you the crucial takeaways. We're talking about the operational momentum, which was quite significant, the impressive financial discipline, and maybe most importantly, the growth catalysts that are, now officially switched on.
Okay, let's dig into that resilience then. That headline number, group EBITDA, hitting $911 million, it's clearly strong.
It is very strong.
But how much of that is just, say, riding the wave of good market conditions, like that summer refining boom we saw, versus, actual company-specific improvements?
It was really a mix of both, and that's what made it work so well. The market tailwind definitely played a part. They absolutely captured those favorable refining margins during the summer, no doubt. But the structural element, the company part, that was key too. They kept upstream production really high, very stable, thanks to some very efficient operations.
Right, you needed that stable base.
Exactly. You needed that upstream stability to really maximize the opportunity on the refining side when the margins were there.
And sticking with the financials for a second, they kept tightening the belt, didn't they? Continued to pay down debt.
They did. Net debt came down further, now sitting at a pretty comfortable $1.2 billion. And this is while they're still executing on some major projects, remember?
That's impressive discipline.
And the leverage metric really tells the story. Net debt to EBITDA. Just 0.4 times.
Wow, 0.4.
Yeah. Management was pretty clear this wasn't an accident. It's central to their strategy. It gives them huge flexibility, and it really acts as a buffer, against potential bumps in commodity prices down the road. It's frankly, sector-leading discipline.
Okay, so that strong foundation needs the operational engine firing on all cylinders. Let's pivot to upstream then. That's where the bulk of the EBITDA comes from, right? How did production hold up in Q3?
It held up very well. Production was steady at 115,000 barrels per day, slightly up quarter over quarter, actually.
Okay.
And they managed that mainly through really high fleet availability and, crucially, limiting unplanned downtime. Kept those incidents below the usual average. So the result was a strong upstream performance financially, too. Their adjusted metric, the upstream RCA EIT, came in at $464 million.
Right. The RCA EIA, that's their adjusted operating figure, strips out some of the noise to show the underlying cash performance. Now, wasn't there a specific kind of one-off thing related to Brazil that they mentioned? An adjustment?
Correct, yeah. A bit technical, but important for clarity. It relates to the TP field in Brazil. There was a slight change in their track participation. It's now 9.06%. So they had to make a sort of cleanup adjustment for past earnings related to that.
Okay, so what's the impact?
The bottom line is an expected cash payment from them of about $80 million. But crucially, that's not due until the first quarter of 2026. So it's basically a settled item, provides clarity, doesn't hit near-term cash flow.
Got it. Okay, let's shift downstream then. Refining and the push towards low carbon. We know margins were good, but how well do they actually capture that environment?
Extremely well, actually. Their system availability was robust, really solid across their facilities, and that let them realize a pretty impressive margin, $9.05 per barrel.
$9.05. That's strong.
Yeah, they really hit that sweet spot, maximizing output right when the prices for things like jet fuel and diesel were highest over the summer peak.
But reality check, those peak margins probably aren't sticking around forever, and they've just kicked off a huge maintenance event, right? The big turnaround.
That's the big factor for Q4, yes. The turnaround started just earlier this month, expected to last until mid-November, so it's significant.
So how do they manage the hit to revenue during that downtime?
Management really hammered 2 points on the call about this period. First, obviously, safety. Thousands of contractors on site, so safety is paramount. But second, and strategically quite smart, they're using this necessary downtime to actually accelerate work on their low-carbon projects.
Ah, interesting. Using the downtime productively.
Exactly. They cited getting the first big electrolyzer module delivered for their green hydrogen project as a key example, turning maintenance into, a strategic step forward.
That makes sense. Okay, moving along the chain, midstream and commercial, often quieter, but important for stability. Anything stand out there?
Well, trading continued to be a strong, steady contributor. What was kind of interesting was the update on their gas sourcing. They specifically mentioned that their portfolio is now getting a significant boost from new LNG supplies coming in from the U.S. Mentioned Venture Global Cargo specifically.
Okay, diversification there.
Yeah, it gives them more geographical spread, more pricing options, good strategic move.
And did that operational stability flow through to the commercial side? Sales, distribution?
It absolutely did. The commercial segment's operating result climbed to $119 million. That's up 28% compared to last year.
28%. Wow.
Yeah, pretty solid growth, driven by partly a better business environment in Spain, but also just continuous improvements they're making in how they run their distribution and sales networks, just getting more out of what they have.
Okay, and while oil and gas is clearly the main event, we have to touch on renewables. What was the story there in Q3?
Solar generation was decent, over 700 gigawatt hours produced. Management was upfront, though, about the challenging low prices in wholesale power markets. That continues to be a headwind.
Right. Tough market for solar right now.
Yeah, but they emphasize their focus isn't just on raw generation anymore. They're shifting towards optimizing revenue streams, looking at things like ancillary services, developing storage solutions, basically trying to make their renewables less dependent on those weak spot prices.
Yeah.
Adapting.
Okay, so putting it all together, the upstream stability, catching the downstream margins, commercial growth, that all fed the cash flow, right?
Directly. Free cash flow came in strong at $548 million for the quarter. And a big chunk of that benefit came from unwinding working capital balances.
Right, releasing cash, which naturally takes us to the outlook. Management sounded pretty upbeat, didn't they? Not just about Q3, but looking ahead.
Very upbeat. They actually raised some targets based on the Q3 strength and the outlook.
Okay, like that.
Well, for full year production, they now expect to be at the upper end of their previous range, so closer to 110,000 barrels per day, rather than the midpoint of 105K to 110K.
Suggests they see Q4 holding up well operationally, even with that turnaround.
Seems like it. And that confidence carried through to the bigger picture financials, too. They basically said they're confident they'll beat their current full year 2025 guidance for both group EBITDA and operating cash flow.
Beating guidance, always good to hear.
But maybe the most telling number for long-term investors, the one that really speaks to resilience, is that dividend break-even point. For 2026, they're projecting it to be just below $40 per barrel.
Below $40 Brent, that's very low.
It's incredibly low. A massive achievement, really underscores how much more resilient the portfolio is becoming, dramatically reduces the risk profile.
Okay, now, the really big news investors were waiting for. Buckalo, the new FPSO. First oil achieved.
Yes, first oil was achieved just recently. This is a huge milestone. Transformative, really. Management described Buckalo as one of the largest and most efficient production units anywhere in the world. This isn't just replacing old barrels, it's adding very high margin, low cost barrels.
So a structural shift for their costs and cash flow.
Absolutely. The big focus for pretty much all of 2026 will be getting that unit fully commissioned and ramped up to its full capacity. That's going to be a major driver of cash flow growth.
Got it. And the other big strategic piece, moving parts, Namidia, the potential asset sale. Any update on the timeline there?
Yes, progress there too, and moving quite fast, it seems. Management confirmed they got non-binding offers over the summer from highly credible players, as they put it.
So serious interest.
Definitely validates the asset's potential. They said they're now in advanced bilateral talks with a short list of preferred bidders. And the goal, they reiterated, is still to finalize a partnership agreement before the end of this year. So clarity on that front seems likely soon.
Okay, so let's tie this all together. You've got this efficiency, the super low break even, a major growth engine just starting up. What's the play here? Time for our This Is Not Financial Advice segment. Pitches something outrageous, but, plausible.
Okay, so the core thesis here is that the market might still be looking at GLP, like just another oil stock, highly tied to the commodity price swings.
Right, the usual correlation.
But the argument is they've just built in some structural insulation. You've got that $40 break-even certainty, which is huge. And you've got Buckalo, this brand new, ultra-efficient cash machine just starting to contribute.
So betting that the company's specifics can overcome the broader market noise, structural premium wins.
Exactly. So the pitch gets a bit technical, think. A long-dated call option on the stock, maybe out to 2027 maturity, and deep in the money. You want leveraged exposure to the upside as Buckalo ramps up fully over the next couple of years.
Okay, a leveraged long bet,
Yeah.
But options cost money. What's the twist? How do you fund it or hedge it?
Precisely. You combine that long call with a short volatility play on crude oil itself. Maybe something like selling a short-dated put spread on WTI, or perhaps even taking a partial short position on the VIX if you're feeling bold.
Okay. So you're using the expected stability from Buckalo.
Yeah, you're betting that Buckalo's high efficiency and low cost provide a sort of internal price protection. It shields the company, and therefore the stock, from the usual mid-cycle oil price volatility. So you sell that expected lower volatility in the oil market to help pay for your long-term bullish bet on the company's equity outperforming its peers, almost regardless of the day-to-day macro swings.
That is definitely a levered bet on execution and that structural efficiency playing out. Interesting.
It's definitely out there, but plausible if you buy into the efficiency story.
Okay, to wrap this deep dive up quickly then. 3 big takeaways from the GLP call. First, that financial resilience is real. Sector leading, even shown by that 0.4x net debt to EBITDA.
Yep, rock solid balance sheet.
Second, the growth engine is firing up. Buckalo achieved first oil, and it's a major high-efficiency asset coming online now.
Transformative potential there.
And finally, strategic clarity is emerging. That Namidia asset process is moving fast with a target for an agreement by year-end.
Good visibility on that front.
Okay, so remember everyone, this discussion, as always, is just for informational purposes. It is absolutely not financial advice.
Yeah, please consult your own investment professionals before making any decisions based on what you hear here.
But we definitely encourage you, the listener, to take a closer look at those efficiency numbers, that low break even. Think about how a major high-margin asset like Buckalo, just starting its journey, could really reshape how the market values this company over the next year or so, long after the noise from Q3 fades.